Monday to Friday at 12:30 p.m. only on Bloomberg Quint.
As far as the regulator is concerned, I keep going back to the product committee report. I think we covered every aspect of what the regulator could potentially do in terms of improving the fortunes of the industry and increasing the speed and the innovation to the market, and at the same time ensure that from a regulatory perspective, the customer is fully taken care of. I think the regulator is moving on it. They have formed a working group now. And I'm hoping that the working group is mandated to come out with changes in regulations, or at least some changes in regulations which can push the agenda more than before. So, and one of the things which you recommended in that product committee report is around retirement and savings and what needs to be done on the pension product. I understand why the regulator is where it is at this point in time in terms of why the commissions to be paid on the retirement products are limited, why there are some concerns around how we can hedge our positions, but I'm hoping that the regulator will give us a little bit more breathing room in terms of what we can do, how we can hedge, so that ultimately we can take a better, customer value proposition to the market.
Do you see your individual business doing better or having a better share? How do you really map that out?
So, well, we are trying to build our business across various product categories, and as far as group is concerned, there are two primary product categories which are driving the growth there. One is the group funded side, which is more of a spread business, but again, from our perspective, it's not just the funding side, but we are having conversations with some of these group clients across, funding, GTI, now NPS, and hopefully gradually slowly even the annuity side. So for us, the group client represents more than just one conversation around group funding. So we are obviously number one in the private space as far as group funding goes. Second, yes, Group Credit Protect has been a large growth story for us for the last couple of years, and it has continued to do well even in this quarter. We grew by 55%. We have more than 170 relationships through which we are deriving this business, and we believe that every large company is having a relationship with us, and we also believe that the opportunity to continue to grow this business remains extremely high. We are very focused on it. We are bringing new innovative solutions to this particular product category so that we can continue to maintain the gap between us and the other competitors. So both the products are actually contributed quite well to our growth story.
Also share to the total new business?
Well, it depends on how you cut the data. I think if you look at combine the two categories at the end of the year, both of them are contributing almost equally to our overall premiums. We don't know what the numbers will pan out and how they will pan out, but if you look at, because the individual business tends to have a much more seasonality, so we are hoping, and I believe that's where we'll end up, that they will kind of end up at almost 50-50, 55-45 kind of range for us as far as the premiums are concerned.
Even as the private players are gaining market share in the industry and LIC is chipping it off bit by bit, with LIC coming out with a new bank, how do you see that would kind of affect the distribution and not affect, rather, improve their distribution and thereby affect the market share of the private players? Do you see any risk like that coming to you?
So firstly, it's too early to comment on what form and shape this LIC transaction with IDBI is going to be, because initially we heard it's just going to be a financial investment.
Yes.
Now we hear again from public reports that they want a management control. So let's see firstly what that shape of that transaction would be. But picking up on a second point, please understand today LIC is already the market leader in terms of the bank insurance relationships that exist in the marketplace. Practically every public sector unit or every public sector bank has a relationship with LIC. So from that perspective, adding another bank is not going to make a difference from a market perspective, because IDBI Federal is not such a large bank insurance player in the overall scheme of things. But yes, the tide could turn. We are in the process of signing our kind of first large public sector corporate agency very soon, and we will obviously announce it to the market at the right time. It just goes to show that, every bank gradually, slowly is moving towards open architecture, and it also continues to demonstrate how strong HDFC Life's acquisition engine is, that we have in a open bidding and a full RFP process actually won this mandate.
Sure, sir. So one last question on the growth. When it comes to the market growth, HDFC Life, at least when it comes to the total premiums, I think grew 37% in this quarter. Going forward, do you see you'd be able to sustain it with the backdrop of obviously LIC coming into the fore?
Vibha is going to shoot me if I start talking about the numbers for the year, but again, we have always maintained one stand, that is that we believe we have the platform to be able to grow faster than the industry, and we continue to believe that. So I'll kind of restrict it to that we'll continue to grow at a rate faster than the industry, and our platform gives us that opportunity to be able to deliver that on a consistent basis.
What led to the reduction in investment income and the reduction in yields, if you could, help us understand what really...
Yeah. So if you look at the reduction, it's really in the unit link segment, because that is the biggest, and also it is a pass-through for us. So while due to, like you said, because of the movement in yields, there has been a negative impact, because there's an inverse correlation to the value of the investment. So as the value of the investments go down, there's a mark-to-market loss, but there would be a mirror movement in the reserving, and so it would be P&L neutral. So it looks like a large movement, but what you will see is when you look at the reserves, there's a mirror movement in the reserves as well. Okay. Everything other than unit linked has grown in line with how business has grown.
Well, that was the management of HDFC Life. Shifting focus now to Havells India, it is seeing a strong reaction to its first quarter earnings. While the company's top line saw healthy growth, margins expanded by 300 basis points. Joining us to discuss the quarter gone by is Mr. Anil Rai Gupta, the chairman and MD of the company. Thank you so much, Mr. Gupta, for taking the time out and speaking with us. First up, sir, your cable business margins, they have expanded substantially with growth seen returning. What, according to you, are the factors behind this quarter's performance?
If you look at last year, definitely the margins were low, but overall, sequentially, we have been maintaining a similar margins. There has been, focus on, brand enhancement and deeper penetration, and hence being closer to the consumer. So I think overall, we've seen improvement in both underground cables and domestic wires in terms of margins.
So the electrical consumers division has shown the most growth in the quarter gone by. What's driven this growth, and is this likely to remain the lead growth driver over the next few quarters?
Well, actually, you can't really see it in that perspective, because last year was a special quarter where GST was going to come from the 1st of July. So a lot of dealers and distributors had delayed their purchases so that they can buy at the time when the new GST regime comes. So the first quarter base was low, and it was mostly impacted in the electrical consumer durables. However, I would say that there's been a lot of initiatives by the company in terms of products. Our focus on fans and premiumization of fans. We have the largest market share in terms of premium fans. Our growth in fans has been quite healthy. So, which is a large part of our consumer durable business. So, a lot of it is also based on internal strategies.
So also a word on your commodity prices. What role is that playing when it comes to margins, and are you witnessing any inflation in terms of input costs?
Well, there had been an increase both because of the dollar movement as well as the commodity price movements. There has been some respite over the last few weeks, and I think generally speaking, at this point of time, the companies have to tighten their belts on the cost efficiencies so that we don't have to pass on a whole lot of it to the consumer. So I guess company has been very focused on that, and hence we are able to maintain our margins.
So keeping in mind expansion, where does the focus lie now in distribution for Havells in its consumer division, and what are the geographies that will see more distribution?
I think more and more with the electrification going into the smaller towns and the rural areas, a lot of focus is now being pushed into going deeper in penetration into smaller areas and smaller towns, and making the products available for the consumer closer to their homes. So that's where the focus is going to be in the next few months and few years.
And so what sort of growth can Lloyd's produce in FY19 as the base effect comes into play?
I think we're looking at a decent growth in Lloyd. I think Lloyd play has to be looked at over a longer period of time, because a lot of things have to come into play, brand building, the product, the manufacturing. So a lot of things have to be looked at over the long term. So we are very, very, I would say, very positive about this acquisition, and I think over the next few years it should play out very well for Havells.
So the lightings and fixtures division, that has seen some weakness in the first quarter, although margins remain steady. What's the outlook there?
No, I think we need to separate the lighting and fixtures business in two parts. One is the government focused ESL business, where we had a sizable order last year. We didn't do any business in this year, but the market business of the lighting business has still grown at 25%. So the market growth is still very healthy.
Thank you, Mr. Gupta, for taking the time out and speaking with us. Well, it's time now to speak to the management of MCX, and Saloni Dhanuka is joining us to take us through the conversation. Saloni.
So Yash, MCX reported an exceptional loss of 24 crore in the current quarter. However, it was an operationally strong quarter for the company. What have been the factors at play? Let's ask Mrugang Paranjpe, the MD and CEO of the company. Good morning, sir. Thank you for joining us on Bloomberg Quint. So my first question to you is, after the launch of commodity options last year in October, how is the trend in terms of volumes, and how is the trading demand in gold options compared to your expectation?
So I think, gold was launched in October, but I think the bigger event from this previous quarter was the fact that we got the approval from SEBI for the launch of the other options contracts. We have launched all the 4 contracts for which we got an approval. And we are seeing a very, very healthy response to these contracts. The crude contract, we are regularly clocking more than 200 crores on the notional turnover. We are getting more than 1,000 participants on a daily basis on many occasions. So it's really building out in a very good sense to be a very, very liquid contract as we move. In terms of, and we've spoken about this, we've always said that for us, a good, healthy options contract is something which trades in terms of the notional at least at about 60% of the underlying, and therefore that's the number we are aspiring to be over the next 2 to 3 years, and that's the number which we think we are absolutely going to be in terms of the trends that we've seen after the launch of 4 options contracts in the previous quarter.
Well, speaking of operational performance, what kind of mix have you seen in terms of volumes for bullions, metals, energy, as well as the agricultural space?
Agri-commodities remains subdued for us. It's less than the 2% that we've seen. But if you look at the trends, I think what we are comforted is that we are seeing a good increase, which suggests that bullion is slowly coming back and will, we hope, tick back to the numbers that we had seen pre-demonetization. So I think that was a number where we were at about 9,800 crores. We dropped to 4,900 in the 2 quarters subsequent to that, and we've been fairly at that 5,000, 5,200 number. But this quarter we've inched about 5 to 6% above on the gold. The crude as well as the base metals continue to perform very well, and that's what's giving us our overall healthy numbers in the ADT.
All right, and MCX has encountered multiple technical issues with its trading system earlier this month. What caused this, and what kind of measure is the company taking to prevent such errors going ahead?
Let me just get down to something which is a very, very technical issue, but when 2 computers communicate, they use what is called the TCP, Transmission Control Protocol, and this involves not just really the application, but also the operating system and the hardware. So it's a very complex reason why we did have that technical halt. Suffice to say that after the incidents, the last one of Monday, we have got a solution which we have put in place Monday night, and we have the confidence that this solution will not encounter the same problem again. We have assured our regulators of the same. We've been in touch with our market participants and given them the same assurance. So I think for your viewers at large, what I would just say is we had an issue, a very, very technical problem which took us longer to resolve than it should have probably. But we've got the solution done, and we feel confident that this issue won't occur again.
Sure, sir. SEBI has approved a universal exchange license, which is likely to increase competition intensity. What's your strategy to protect volumes, market share when BSE and NSE will actually launch commodity trading?
You know, it's a very welcome move. We always liken this to what happened in the car segment in India, when in the early 90s we had very few participants. There were mainly 2 or 3 manufacturers from Indian origin, and then the complete market was opened up for every big, small participant from all over the world. There was this huge concerns that Indian manufacturers would always have some problems, but as we've seen, at least 2 of those have become the largest car manufacturers in the world today. So I think competition grows the entire market. We think it's a great thing for the market overall. From our perspective, we believe this move will benefit the market because more participants will come in. In terms of our contracts, we believe we have contracts which were designed over a very long period, which are absolutely close to what the market needs. These contracts are not exactly very easy to replicate, and therefore we will be able to maintain the liquidity in our contracts. Notwithstanding what we just spoke earlier, I think our technology in terms of its performance is absolutely comparable to what happens in other exchanges. So I think we are very confident that we will maintain the liquidity that we have in our existing contracts. Added to this, we believe there's great opportunities coming in the commodities segment when it comes to spot markets opening up at a later date. So commodities remains probably the most exciting place to be, and that is where we will focus our energies as we prepare for competition.
So apart from commodity segments, which are the segments that MCX is planning to enter, be it equities, debt, interest rate, or derivatives, currency derivatives? Any thoughts here?
Suffice to say that there is no immediate plans to enter any of these segments. Of course, we keep evaluating this. Of course, currency makes a very, very strong case in terms of its adjacency to commodities, but as a business case, we will evaluate it at every point of time, make sure that our resourcing in terms of our technology and other resources is something that we can push in that direction, but no immediate plans of entering any segment come October 1st.
All right, sir, it was pleasure speaking to you. Ceat Tires reported a strong first quarter with a substantial jump in net profit as well as on the operational front. Let's discuss the quarter gone by with Subbiya Kumar, the CFO of the company. And Yatin is joining by to take us through. Yatin, over to you.
Thanks for that, Saloni and Mr. Kumar. Thank you so much for joining us. First of all, I would like to ask you about the first quarter numbers, which have been quite strong. If you could tell us which were the segments which were driving the growth for the company, and there was a good amount of margin bump up also that we saw in the quarter. So was the replacement market so buoyant, because of which your overall sales mix and product mix was better than the street expectations?
Yeah, first of all, thanks for having me on your show. Okay. And yeah, with respect to your questions, it was a good all-round growth across all categories and business units. However, between various business units, our growth in OEM as well as exports was higher than replacement segment. The margin has moved up significantly over same quarter of last year, predominantly on account of lower raw material prices and better product mix. And when a turnover also increases beyond certain threshold, okay, it also leads to improvement in overall margins. I must say, in terms of overall, I think it was a good quarter across all categories and business units.
Okay. Sir, also I would like to ask you about the margin, outlook moving forward. There were reports that there is, shortage of carbon black, and if you also could comment on that as to how really, are you sourcing carbon black, and also crude prices, have come off the peaks. So do you think from here on there could be some upward, revision on the margin outlook for you? Can we expect margins in excess of 11 to 12% on the EBITDA level?
Okay, see, if you look at our margins from Q2 of last financial year onwards, in the last 4 quarters, we have reported upwards of 10% EBITDA consistently. Okay, it was only in Q1 of last year we had issues arising out of both GST as well as substantial increase in raw material prices. Our raw material prices are likely to, cost is likely to go up in Q2 over Q1. Predominantly due to increase in crude oil prices. Crude is hovering around $75 per barrel. And the second, reason is that rupee has also depreciated substantially. So therefore we expect raw material costs to go up in Q2 versus Q1 and also versus Q4 of last financial year. Your second question on carbon black. Carbon black supply situation has been tight for over 4 quarters, and one of the reasons for substantial increase in demand versus supply is also because the import volumes had come down from China. The local carbon black players have done some capacity debottlenecking, and therefore we are able to source carbon black to the extent it is required. And from tire industry's perspective, we would certainly expect carbon black to increase the capacity going forward in line with the increase in demand for tires.
Okay. And sir, talking about the capacity utilization, how is the capacity utilization for the first quarter, and do you expect some improvement moving forward as well?
See, capacity utilization is pretty high for us. In commercial category, truck and bus radial, we are running at full. Passenger car capacity utilization is also high, and two-wheelers also. Our last quarter, we had grown strongly, and therefore there also capacity utilization is high, but there is some scope for us to produce more in our existing facilities. For Ceat, Q2, we would have constraints in terms of availability of capacity, and our new truck and bus radial capacity is coming up only by end of Q3. So even in Q3, we would have issues in terms of capacity being lower than our demand. Only from Q4 onwards, we should have some headroom with respect to truck and bus radials. And in the coming financial year, maybe in some time in Q2 is when our passenger car radial capacity is likely to come up. Then that will also help us to meet our demand with the additional capacity coming up.
How much will you be spending on capacity expansion in the next 12 to 24 months? If you could give us an estimate for that.
In the current financial year, our capacity, our capex on new projects, we expect it to be around 1,500 crores.
Okay.
1,500 to 1,700 crores. That is the range in which we expect in the current financial year. In the next financial year, also we could be spending about 1,500 crores on capex. That is our current estimate of capex for the current financial year as well as the next financial year. Overall, we have drawn up a capex plan of about 4,000 crores over a 3 to 5 year period. The amount of capex that we would be incurring from the next financial year also depends on capacity utilization and also expected demand, but expected range is what I have explained.
And I was just going through your first quarter investor presentation, in which you mentioned how you are looking gradually to improve and increase the dealership network. If you could give us an idea as to what is the kind of dealer network addition that you are looking at for the next 12 to 18 months.
Okay, see, if you really look at, we have been growing in volumes, particularly in passenger car categories. Strong dealer network and distribution network is critical for us to sell the incremental volumes. We have increased the number of our own Ceat shoppies, and second, in terms of dealership, we are also now getting into smaller towns to ensure that Ceat tires is available across India. So the data relating to the number of dealers and distributors is available in our investment deck. Okay, you would see about strong double-digit growth in terms of number of dealers and distributors. That has increased our coverage across the country, and which is an important enabler for us to sell our additional volumes.
Okay, we leave it at that, sir, and thank you so much for talking to Bloomberg Quint on your first quarter earnings, and all the best for the coming quarters. So that was the management of Ceat. The growth look healthy. Of course, higher crude prices is something which could keep the margins under check. But with that, it's a wrap on Q1 with BQ. Up next is the F&O show.